You are a noted Fed watcher, and the Fed just recently came out with some new appraisals of how the economy is doing. Do you think that they are now having a more realistic view of what's going on?
I do think so. I think they've marked down their forecasts fairly significantly, and in their notes actually used the word downturn, which some might think is a euphemism for recession. We think a recession basically is already here. I think there's a fairly strong argument. We've had some major forces working against the economy, and we see that combined with downturns in the major indicators, particularly employment. Then you have a fairly strong case for us being actually in a recession now.
You were one of the early forecasters of the problem with the housing industry. How did those forecasts benefit your clients?
Well, I think that contributed very much to our overall economic view. For instance, what we saw, which was really important, was housing prices. Housing prices almost never go down, and we saw housing prices start to go down 1, 2, 3 months in a row, 4 or 5 months in a row. Now we're down to 16 months in a row. So when we saw that early on, we saw a deflating asset bubble. And the last time there was a deflating asset bubble, a stock market bubble, that was caused by the Federal Reserve, which this one was as well. The last time it caused a recession. So I think if you've got a number of factors in addition to this housing market bubble bursting, pretty strong indicator of slowdown in business conditions coming on.
And specifically, were clients able to evaluate this analysis, and did you keep them out of trouble?
Well, when I first started presenting the idea of the fact that we had this burst asset bubble along with high oil prices and along with the lagged effects of the Federal Reserve tightening monetary policy from 2004 to 2006, I think when I started presenting that, people weren't real happy about hearing that. But as the evidence kept coming forward that this probably was the case, I think it made some of our clients realize they better prepare for what's coming, and perhaps they changed their business decisions along those lines. Maybe a bit more cautious about extending credit, maybe a bit more cautious about making forecasts for sales in the future, things of those nature.
From a global perspective, the U.S. is not Euler Hermes' major market. I think it's about 5th in terms of its revenues. How do you foresee what's happening in the U.S. reflected globally?
Well, there's been this thinking for some time up until now that this time around in the business cycle, the U.S. would decouple from the rest of the world. And part of this was the influence of growth in China, for instance, and in India, and the fact that we didn't seem to be in phase with the rest of the world. We see now that's not true. Still, the U.S., with at least a quarter of the world's GDP, really influences very strongly the rest of the global economy. So we see, given the fact that the U.S. is slowing down, we see it's quite likely that global growth will slow down as well. And from our point of view, you would expect that imports to our country would be slower because we expect slower growth here. On the other hand, the weak dollar we expect to help support exports to the rest of the world. We've got to balance that against the slowing global economy, though. So we see, the global economy is trailing us a little bit in time, still very much coupled together with us.
Meanwhile, Euler Hermes, according to last year's results, is doing very well, and the annual report looks positively for the company's welfare this coming year. Could you explain a little bit how that works, where Euler Hermes can weather whatever's happening in the U.S. economy or globally?
Well, in good times, which we've had up to now, we can have more of a risk appetite. That is, we can be more aggressive in terms of protecting our customers. If they want to have coverage on what might be a risky credit, we might be able to say, the economy has looked in good shape, so we might take that risk for the benefit of our clients. And so that works pretty well when economic times are good. When things turn down a little bit, as we expect them to, we might have to warn our clients, give them information saying, we expect credit conditions not to be quite as good as they were. And so our risk appetite has to come down a little bit to manage what we see as forecast and degrading credit conditions. So that gets to be a little bit more of a difficult atmosphere for credit insurance when we see conditions turning down. It's a bit tougher for us and for our clients.
Could you tell us about what indices you look at carefully?
Well, we look at everything that comes out, is the short answer. Recently we've been focusing very much on employment. And the simple reason is because we've had this hypothesis that the economy has been slowing fairly dramatically. And usually the last thing you see to degrade in this type of situation is the employment. And typically this is because employers don't really want to lay off people unless they feel conditions are going to get really bad. So there's a lag there. They won't lay people off until they really have to. And by the time you see that, you can be sure that you're in a recession. And that's what we saw last month, was negative employment growth. And that really was kind of the final nail in the coffin for us. So we'll keep continuing to watch that going forward, perhaps more importantly than other things.
Do you work with economists around the world, Euler Hermes experts?
Yes, just this morning actually I was on a conference call with our compatriots. We had a conference call between our colleagues in Paris and in Germany and in the UK, discussing again primarily what the U.S. situation is, our situation, because again we drive to a large extent what the global economy is, like it or not. But also we talked about the Eurozone, which is the second largest economy to the U.S., almost the same size. So we have a very close working relationship with the rest of our group economists, and even some of those economists in Europe specialize in emerging markets in the BRIC countries, Brazil, Russia, India, China. So we work fairly closely with coming up with a global viewpoint that again is driven to a large extent by the U.S., but also by forecasts for other major countries.
Let's say you're the CFO of a small to medium-sized company based in Georgia. How can Euler Hermes really help in terms of planning for the future?
Well, we get a lot of reports from our clients these days that they're getting slow pay. That is, they've shipped goods on open account hoping to get paid back. And typically terms might be 30 days, sometimes 60 days in different industries. We're finding that not getting paid back nearly as fast as they're supposed to. And sometimes this is a pretty good precursor to bankruptcy. They're getting slow pay now means they may not get paid at all coming forward. And that's when it makes a lot of sense, I think, for both us and for our clients to get together so that not only can we protect them against the possibility of failure, we can provide information to them ahead of time because we have people on the ground, credit underwriters that have a very good feeling for what bankruptcy conditions might be, and they can help protect our clients before there's ever trouble. At the same time, if businesses in Georgia are trying to expand into other markets, we can offer protection there as well, because if you're trying to make sales into a market that you wouldn't otherwise, for instance an export market, we can help protect there, because if somebody in an export market decides to go bankrupt and not pay you, you're pretty well out of luck unless you have an insurance policy to try and cover that indemnification.